Hi everyone, this is Rob Roy and welcome to the Elliott Wave Options S&P 500 US Market Update. Wow. When it comes to the news out of the Federal Reserve today, that's about all you can say. So let's look at the charts. Awful lot of news came out this weekend, and we have a long holiday weekend ahead of us, so I'm going to do two recordings this weekend, this one and one other one. And while I'm thinking of it, at the end of the weekend, I'm going to give away a free 12-month subscription to our full alert service. That's both portfolios, the impulse and the volatility. All you have to do to enter is hit the subscribe button and then post your favorite Chuck Norris one-liner. Y'all been having fun talking about me looking like Chuck Norris, so give us your best one-liner, and at the end of the weekend, we'll pick a winner for that 12-month subscription. So today, the Federal Reserve came out and basically said, we're going to do whatever we want. And Section 13.3 of the Federal Reserve Act basically gives them that right. If you're not familiar with who the Federal Reserve really is, you should. I'm going to post a link here on this video to a podcast that I did with Andy Hecht where we talked a lot more about who the Federal Reserve is, how they work, etc. So if you have some free time this weekend, maybe give that a look. But basically they came out today with a new $2.3 trillion stimulus package where they said we're going to buy even high yield bonds, better known as junk bonds. Now it's true, we have Macy's, Delta, and Ford, whose bonds have now gone to junk status. Wouldn't necessarily view those as companies that would have junk bonds, but they are now. But still, it was one thing the Federal Reserve said they were never going to do. So the market moved to the upside on this another $2.3 trillion coming in, and that moved the market up to the 66% fib correction level. We were hovering 2 days at the 61.8% level. So what that means is we're getting some answers now. What that means is that by breaking above that level, we have now disqualified this Elliott Wave 5 pattern. So this is no longer a qualified pattern. So what we do now is we move to what I had talked about before, which is the fib retracement of the entire move. So we just simply do a fib retracement of that whole move, and we know now that this zigzag is completed. We've talked about it. Was it? We had this bounce here from that 100% extension level. Were we going down to a further extended 261.8% level? That's not happening. We know this zigzag is done, and we have now corrected. So this is now a qualified big A, meaning this completed zigzag is a complex A wave. And then we bounced up here right to, and take a look at that, 50% corrective level. So this entire down move has now corrected 50%. Elliott Wave is great. The Fibonacci levels are great. That's just basic technical analysis when you have a big move in one direction followed by a 50% correction. Now notice within that B wave, we had another zigzag right here. So we had this zigzag right there, so we have a complex A and a complex B, which means the C wave could be mono, meaning it could move down quickly to the downside. Now the other thing that could happen is we have a doji here at the 50% level, so Monday's going to be interesting, but we could still move up to the 61.8% level, and the entire scenario is still intact of a potential downward move. So let's go ahead and do this fib zigzag extension here of this whole move to give us a potential target down here to the 160 level. Now we'll redo it if we bounce up to 61.8, but that could happen now. I think that's going to take some time. The 5-wave pattern was calling for the 5-wave much quicker than this. Don't think it's going to happen quite this fast, especially with the Federal Reserve basically saying we're not letting anything go down, we're buying everything. So let's take a look at that high yield bond chart because it's interesting as well. There's another one of those triangles, the triangles that we've been talking about here. We just had the one in the S&P, and when you have a triangle pattern, you know that you're going to get a breakout. You don't know which direction, but you know you're going to get a breakout. So let's do a little options education here real quick and take a look at what the risk graph looks like of a strangle. That's the position I've been talking about where you can buy an out of the money call and an out of the money put. A lot of people are familiar with straddles where you buy an at the money call and an at the money put. The straddle risk graph is more of a V shape than this U. If you're not familiar with how a risk graph works, this vertical axis is profit loss and the horizontal axis is the stock price. Now, I think that's a little bit confusing to see. So let's do a little animation here and turn the graph on the side, which I think makes it a whole lot easier for you to understand. So now we have the risk graph parameters here with the date down at the bottom, the stock price. So the time at the bottom, the stock price, we have a stock moves to the upside and then moves into one of those triangle patterns. Now at this point in time, you don't know which direction we're going to break. It's a triangle. Looking at the risk graph here, you have this small amount of risk. Remember, with the straddle, you had a lot more risk. You would have had a much deeper V here. But you do have to have the stock move far enough to offset what you paid for the out-of-the-money call and the out-of-the-money put together. So looking at it here, I think it's a lot easier to see. If the stock breaks to the upside, we start running up, and then we get to the point where the entire position is now profitable. Or if the stock were to break to the downside, as the stock moves down, once it moves to this point here, we've made enough for the entire position to be profitable. So I think that makes the whole strategy a little bit easier to understand. Now let's go back to the chart of HYG. Triangle is right where the wave 4 corrective forecasted level was. So it would be easy to look at this and say, well, we're in a wave 5 pattern. We're going to the downside. I know we have a triangle here, but why bother paying for the calls? Let's just buy puts. We know we're going to break to the downside. But Elliott himself said that when you have a corrective pattern, it supersedes the 5-wave pattern. So if you have a flat zigzag or triangle, default to those patterns and forget the 5-wave pattern and focus here. And following Elliott's rules would have saved you a lot if you had looked at this, looked at the Elliott wave pattern and just bought puts, because when the Federal Reserve came out with their announcement today that they're going to buy high yield bonds, boom, look at what happened. There was the breakout to the upside, not the downside. So putting the strangle on, you would have had a nice profitable day, but had you looked at the Elliott wave pattern and just bought the puts, wouldn't be feeling too good today. Hope you found that informative. Look forward to talking to you again next time. Don't forget to hit subscribe and enter into our free giveaway. Talk to you soon. If you like these recordings, I'd like to invite you to join our new Trade Finder Live, where each and every week we do a live webinar where we talk about the market, but we also go a little more in depth into the technical analysis system that we utilize to forecast where the market's likely going to go, and also to identify trading opportunities. Get your free subscription today. Take care, everybody.